The game has changed. If you're still investing as if it were 2021, you might be making a critical mistake. Howard Marks, one of the world's top investors, has issued a warning that few are taking seriously, and those who ignore it could lose a lot of money. In recent years, we've seen tech stocks skyrocket, startups raising billions, and investors making fortunes with little effort. But that reality is over. The Federal Reserve has raised interest rates, the cost of money has increased, and according to Marks, investors need to rethink their strategies now. If you don't understand this new market phase, you could be heading toward disappointing returns or even significant losses. In this video, we will break down Howard Marks' insights on the future of the financial markets. We'll discuss the most dangerous mistakes investors are making right now, the opportunities that few are seeing, and most importantly, how you can position yourself to make money in this new reality. So if you want to protect your wealth and keep growing financially, stay until the end. These insights could make all the difference in your investments. For years, investors enjoyed an exceptionally favorable environment. Near-zero interest rates made money cheap and abundant, making it easier to access credit and fueling stock market growth. This scenario created the illusion that investing was easy. Just buy stocks and wait. But as Marks warns, that party is over. Now with higher interest rates, companies need to justify their value with real profits, and investors can no longer count on automatic capital appreciation. What worked 3 years ago could be a big mistake today. If you don't revise your strategy, you might be positioned in the wrong market at the wrong time. Marks emphasizes that investors must stop expecting extraordinary returns in an environment that no longer supports them. If money now costs more, risks increase, and clinging to old strategies could be costly. If markets were logical, stock prices would reflect only a company's fundamentals. But the reality is that markets move through cycles of euphoria and fear, and Marks warns that we are living in one of those moments right now. The artificial intelligence boom has sent companies like Nvidia soaring in value, but do all AI-related businesses really deserve the valuations the market gives them? Many investors are buying stocks just because they are going up, without analyzing the fundamentals. And Marks has seen this movie before. He reminds us that in every bubble, investors always find justifications for inflated valuations. In the late 90s, people believed any company with a website would become a billionaire enterprise. Now the new narrative is that artificial intelligence will change everything, and yes, AI is revolutionary, but that doesn't mean every company in the sector will be profitable in the long run. Those who don't learn from the past may repeat the same mistakes, and when the market corrects, many who bought at the peak will pay a high price for it. Howard Marks issues a warning few want to hear. Market history repeats itself. The dot-com bubble of the 90s was a classic example. At the time, any internet-related company was seen as a foolproof investment, until suddenly, everything collapsed. What happened? Investors ignored fundamentals and blindly bet on hype. When reality set in, trillions of dollars evaporated, leaving only a few winners. Today, something similar is happening with artificial intelligence. Companies without sustainable profits are being traded at extremely high valuations. The market is pricing in a bright future, but not all these companies will survive. Marks makes it clear, following the trend and buying stocks just because they're going up is not a strategy. The smart investor looks beyond the hype and finds assets with real long-term potential. For years, investing in fixed income was almost useless. But with higher interest rates, that reality has changed. Now, Treasury bonds offer yields around 4.2%, while high-yield corporate bonds, known as junk bonds, can reach 7%, providing an interesting alternative to stocks with less volatility. Howard Marks highlights that many investors have yet to adjust their portfolios to this new reality. If stocks were once the only viable choice for strong returns, now it makes sense to reconsider that strategy. This doesn't mean the stock market is dead, but the balance has shifted. Those who continue investing as if it were 2021 may be leaving money on the table, or worse, taking unnecessary risks. Given this new scenario, the question is, how do you adapt to continue growing financially? Marks's answer is clear: diversification. This means exploring sectors that tend to be more resilient in uncertain times, such as infrastructure, healthcare, and energy, as well as seeking assets with stable cash flow. Now is the time to balance your portfolio, reduce exposure to risky assets, and explore opportunities in more stable sectors. Additionally, keeping a cash reserve can be a huge advantage when the market corrects, as it allows investors to seize unexpected opportunities. For example, if an investor had maintained liquidity in 2022, they could have bought shares of solid companies at a 30% discount during the market downturn. This also reduces the need to sell investments during crises, protecting your portfolio in the long run. Another essential point: avoid investing based on hype. If you can't clearly explain why you're buying an asset, you aren't investing, you're gambling. The biggest mistake? Thinking the market will continue operating as it did before. Those who fail to adjust their strategies may be caught off guard. Marx reminds us that economic cycles change, and sticking to the old model could be fatal for your portfolio. The best way forward? Invest with discipline, focus on fundamentals, and a long-term vision. This means seeking assets that genuinely create sustainable value, such as companies with strong cash flow, sectors less sensitive to economic cycles, and fixed income securities that offer competitive returns without excessive risk exposure. Those who ignore this new phase could suffer significant losses, but those who know where to allocate capital may capture one of the best opportunities of the decade, taking advantage of market corrections and identifying undervalued assets with solid growth potential. The market is changing. Will you adapt or be left behind? If this video helped you, leave a like, subscribe to the channel, and turn on notifications. And check out the pinned comment for essential book recommendations on this topic. Now tell me, what are you doing to protect yourself in this new market? I'll be reading and responding to the best comments.